Welcome folks, this is another tutorial from the Gamma Optimizer room. It has been open to everyone. It's a public video and a recording will be present on YouTube. So in case so you can tell your friends that can't watch it, they can watch it later on in YouTube. So let's start with let's talk about Variance Risk Premium. It has a very sophisticated name, no, to say it in some way. The name is a little fancy, but the concept is very simple. So why are we going to talk about Variance Risk Premium? So the motivator of this particular class is the fallacy of time decay. So a bunch of people that come to the Gamma Optimizer room, I guess it's a rite of passage. Every time a new member joins, I guess he's expecting us to be doing this kind of strategies. But for all of you that have been in the room for quite some time now, you know that I don't do them. I don't do any. I don't sell time decay, or at least I don't do them. Don't do those kind of strategies as explicitly. We have a component of time decay in our trades, but it's not quite what people think. So what is the fallacy of time decay? I mean, I don't know why the internet, books, and popular culture are full of references to this concept of generating income by selling options, in particular by selling very short-term options. I really don't know how you can do that. First of all, there is no such thing as income, because income means like a guarantee amount of money that you receive. There is no such thing as a guaranteed anything. The profit with options is the same thing that the profit with shares is all speculative. If the trade goes well, you make money. If not, you lose money. There is no such thing as income. There is no way to, I'm going to retire from work and I'm going to work on income strategies and live my life out of selling weekly options. No, that's false. You cannot do it. And interestingly enough, there are many structures that are recommended for this. For instance, the internet recommends doing iron condors, or sometimes doing diagonal trades where you sell a short-term option and buy a longer one at a different strikes. You get to keep a premium. Some people advocate using butterflies or calendars. Anyway, structures are dime a dozen, but all of them want to do exactly the same. What all of these structures want to do is capture the option premium, but that's impossible. Capturing option premium is not a source of income, is not a source of profit, because there is no edge. So if you really think about all of these trades that are proposed on the internet, if you do a statistical analysis of those trades and you actually check performance versus real life, you will notice that the edge long term is negative. The edge is negative for two reasons. First, because there cannot be arbitrage. I mean, there is no such thing as a risk-free trade, no free lunches in the market. If time decay were a viable strategy, everyone will be doing it. I mean, it will be the most exploited strategy in the market, and there will be billionaires out there, way more billionaires than they are right now. And the reason that people that sell time decay are not billionaires is because there is no money to be made. Edge is negative. In the long run, you lose more money than what you make. And the reason is that a single failed trade will basically destroy all of your income for the year. And for those of you that follow my videos, you know that the reason is that all of those trades involve selling very cheap options. So you are selling very cheap gamma, and you are exposing yourself to a tremendous amount of gamma risk if the move is against you. If the underlying breaks the range, or if the market drops too much, at the end of the day you will pay orders of magnitude the income. You are selling pennies to make dollars. So, and one of the reasons is that time decay exists is because it's a very well-known property of options. Time decay is not something magical. Time decay is like, man, options are decaying. Like, what? No, options decay because that's expected. They are non-linear products that have convexity. So that's why they decay, because the time decay is in exchange for optionality. So if you are selling the time decay, you are selling that optionality, and that's the risky business. Selling optionality is an incredibly risky business because you are on the other side of a very profitable trade. The people buying optionality stands to make lots of money with very little capital, and you are on the other side of that trade. You stand to lose lots of money with very little gains. So the other reason that this doesn't work is because it is impossible to isolate time risk. I mean, if you could find a way to only isolate time decay and eliminate, for instance, gamma risk, then you will be incredibly rich. But there is no way, because the moment you hedge away gamma, then there is no decay. That's what it is. The decay happens because of the existence of gamma. So it's impossible to be hedged away. So that's kind of a sad situation, and I get this situation in my room where people, they really would love to see this kind of weekly or systematically, periodical strategies that generate some money. So the question is, are there really any edges left in the market? Are there ways to extract money in the market? And this is a very interesting discussion. It's ongoing, and of course there are plenty of hedge funds and all sorts of different proprietary tradings that are doing that. They are trying to find those edges, but most of the well-known edges are gone. They are being exploited, heavily exploited, even at this very time, that I am giving this presentation. So for all practical purposes, most of the edges are gone. However, for some strange reason, the volatility space still contains edges. I have a question, so I will try to answer the questions towards the end of the presentation, because this will be a YouTube video. So I'll save the questions. I'll come back, don't worry. So I'm saying that the volatility space contains some interesting inefficiencies. And it's interesting because they are still there. They have been there for 20-25 years, even longer. So there are groups that argue that these inefficiencies are part of the market, and therefore they are actually fair, and the market is actually fairly priced and efficient. My opinion is that there are structural issues in the volatility market, in particular in the index volatility market. So this is the market that is defined by XPX and in some extent also NDX or Russell 2000, anything that is index. So there are still many inefficiencies, many anomalies, and one of them, the one for the talk today, is variance risk premium. There is an interesting anomalies right there about it, and for some reason is persistent. Variance risk premium in index seems to be a persistent anomaly. So in order to understand it, let's go back just a little bit and talk about variance. So what is variance? Okay, so in general, variance is just a statistical concept, and it measures the dispersion of points away from some particular line. For instance, imagine this is a line and I have points up and down, up and down. So variance measures how dispersed the points are. Maybe I could do a little presentation of what the variance looks like, but let's do that in another occasion. In general, if you want to know more about variance, check online resources and any stack books. But variance is a very simple mathematical concept. In the case of markets, the variance in the markets are measuring the dispersion of something called log returns. Log returns, it's a fancy name for just a basic computation. Is take the close that you have today divided by the close yesterday and take the natural logarithm of that. That's called a log return. The market is obsessed with that. I mean, for some reason, financial people and economists are obsessed with log returns. Well, I know the reason. The reason is that log returns are stationary, they tend to remain within a range, while price doesn't have bounds. No, look at the market, like all-time highs. So the market can go to infinite, but log returns won't. Log returns remain within a range, and that's good if you want to run some statistical analysis on it. And variance, for instance, benefits for having a well-behaved data series. So that's why they transform the price of the market into log returns. So that's what variance is measuring. So up to this point, variance is just some abstract mathematical concept. It doesn't exist. It's just a number that is computed. No? But there is an interesting connection between variance and VIX. You all know the VIX index. No? In fact, last week I had a video about VIX futures and whatnot. So what many of you don't know is that VIX is really the variance of the market. And more concretely, VIX is the expected future variance of the market. So what VIX is telling you, that little number that right now is like 9 point something, what VIX is telling you is that for the next 30 calendar days, we are expecting a variance in the market that is equal to 9.8. Of course, those units are slightly different to the units that statisticians are used to. So VIX is a measure of variance, but it's published as an annualized standard deviation. So VIX is the implied volatility that VIX is displaying is just the square root of that expected variance, and they just analyze it, and that's it. So when you see 9.8, what it means is the market is expecting an annualized variance for the next 30 days of 9.8% of current log returns. That's kind of what the market is telling you. But there is a tremendous connection. So VIX is a measure of expected future variance in the market. It's not the fear gauge, as some people call it. It doesn't measure fear, it doesn't measure anything like that. It measures what the market is expecting. What market? The options market, because VIX is computed from SPX option prices. So yeah, so VIX is connected to SPX options. That's an interesting connection. I hope that you knew that, and if you didn't, well, that right there is a connection between option prices and VIX. So there is a mathematical magic that can be done to option prices for SPX, and you do all this mathematical process and you get this expected future variance for the next 30 calendar days. So it's a very useful measure. Now we can see what the market is expecting in the future. Okay, so that's VIX, and as you can see, VIX is computed from option prices. And why option prices? Why not share prices? Well, the reason VIX is computed from option prices is because options really, the price of an option really depends on the future variance. So options are priced based on that. So the only thing you have to do, so if every individual option is priced with expectations of future variance, then you can take all those prices which are publicly available, mix and match them, and compute like the aggregate expectations of all market participants. And that's what VIX does. Now that's what VIX is doing, is like the expectation of every market participant captured in a single number. So that's what the option prices reflect. And in a fair world, in a perfect universe, in a world where things are priced fairly, you will expect the implied variance from option prices. So I mean, when you do all this formula, you will expect that all this implied variance, you will expect it to match the actual realized variance that happened 30 days after. No? After all, it is the consensus of the market, and you will expect that the market is really smart and they know how to price, and you will expect that they match really well. But of course, this is not true. It's not even close to being true. The difference between the variance that is implied from option prices and the actual variance is gigantic. In fact, it's consistently overpriced. The implied variance is consistently, historically, since the beginning of times, well, since the beginning of options trading, it has been consistently overpriced. So now with that, I finally can introduce what is variance risk premium. So for this discussion, just for this video, variance risk premium is the difference between that. Is the difference between the implied variance from option prices and the actual realized variance that happened. So the funny thing is, because that's the definition, it can be computed from all public data. The only thing you need to do is to compare the VIX value today, for instance, 9.8 or whatever it is right now, and then 1 month later, 30 days afterwards, you can compute the realized variance on the market and see how did it do with that 9.8. The difference between the two is called the variance risk premium. So you just subtract the two. In a perfect world, it should be 0, or it should be very close to 0. Now there should be no difference, but that's only in a perfect world. In the real world, is huge. So here I'm going to show you historical variance risk premium computed from real data, and I'm showing different time frames. So for instance, the first chart is showing you all the way from 2008 to 2017. So we have here 9 years of data in this time. So what is happening? What happens here is that for most of the 9 years, the variance risk premium is positive. So it's not 0. In fact, it's really far from 0. And in a few instances, not many, is negative. So if you are a really good trader, you can start seeing an opportunity here. You can start seeing an opportunity because, like, you say, man, this looks interesting. Look how variance risk premium is mostly positive with very few and limited negative things. For instance, in 2008, of course, there was a tremendous difference between realized variance and expected because we got a market crash around 2008, 2009. So that period was terrible for the strategy. But even it was bad in the long run. If you add all of the profits from the positive cycles, they are substantially higher than the drawdowns you have, and they are very expected. This is the crash of the financial crisis. This is the flash crash in 2010. This is like Grexit. No one talks about Grexit anymore. This is when everyone thought that Greece was going to leave the European Union. And this major was last year. We got a good scare in the market, like a mini crash, and then the market recovered. So, and here on the right, I can show you the chart since 2016. So the last 2 years of trading, almost 2 years of trading, the periods where it has been negative are only like 2 or 3, and it has been negative very little, only 5 points difference between the two. Most of the time, it has been positive. An interesting thing that I want to point out is that during 2017, it looks like the variance risk premium has been collapsing. And I'll come back to this later. But in general, you notice how historically it has been really high. It has been around 10 points. Like the mean is probably around 4.2 points. So there is something there. This is an anomaly in the market, and it's an exploitable anomaly. It's not only a mathematical curiosity. The funny thing is that variance is something that can be traded. It's very interesting. This will be a mathematical curiosity if it were not for the fact that we can actually trade variance. So the question is, why is mostly positive? Why variance risk premium is positive? And so you can see it from the charts. And you can see that a strategy that you define a strategy even back in 2008 that it was designed to consistently sell variance, you will have a positive edge. So the expectation of return of this trade will be positive. But how is this possible? I mean, when it's so easy to identify, if I identify the trade, you could imagine that millions of people had identified the same trade. How is possible that it exists? I mean, it should be closed by now. There should be no variance risk premium if everyone was exploiting it. So the real answer to this is no one has any idea why it happens. Like, there are many theories why there is a variance risk premium. My favorite ones, the ones that I think that are closer to the mark, are because options are instruments that are very hard to replicate in real life. No, so the theoretical framework for option pricing is very different to what really has to be done when you are an actual option dealer. So the difference between the two worlds creates the difference in prices that create this positive variance risk premium. And one of the things what is impossible is that most of option pricing theory will require you to hedge continuously your options positions, and this is impossible. No one can hedge continuously, because first there will be infinite cost to it, because hedging is a transaction, and if there is a transaction cost, no matter how small it is, if you do it every microsecond, you will accumulate substantial costs. So hedging is done periodically, but it's not as frequent as it should be. So it introduces a difference between the theoretical framework of pricing and the real pricing. And also, one of the biggest assumptions ever in all of this theory is that the log returns are diffuse continuously. I mean, there are no big jumps, no discontinuities, but that's not true, because these discontinuities happen, for instance, during market crashes. Like, the volatility comes to a certain value and the market crashes and the log returns move substantially. Those are called jumps. So the presence of jumps in the log returns introduce also inefficiency. So these things can never go away. I mean, those are the structural things. This is structurally, it's impossible to replicate options perfectly. It's impossible to continuously hedge, and jumps are present in the market. You cannot guarantee that the market will be always smooth and nice. There are jumps. So as long as these things exist, the variance risk premium will also be present. And now the big question of the presentation, the big question is, can we profit from this? Of course, yeah. In principle, yes. And in fact, I'm going to give you right here in this slide, I'm giving you the strategy. And for reference, this is a strategy I used to do back in 2006, like many years ago. I used to run a fund where we were doing exactly this. No, so this is not like trade secret. I mean, it's not that I'm giving you like the biggest secret in the universe for free. This is something that is well known, and it has been done since in the past. I mean, more than 10 years ago, I used to do this all the time. So the strategy on that fund was a variation of this. At the start of every month, we will sell a variance swap with 30 days on it. That's it. We will just sell 30-day implied variance, and we will do that every month, no matter what. That's it. and we made lots of money. And in fact, the financial crisis in 2008 and 2009 was right there in the middle of this strategy, and we were ahead. Our drawdown was nothing. It was like ludicrous drawdown, even on that. In fact, we suspended the strategy a little bit, but even with that, it was fantastic. So the question is, so if it's that good, why isn't everyone doing this already? And yes, they are. This is probably the most popular trade in the market. I mean, this trade, you don't see it. You as a retail trader, you don't see it, but this is probably the most popular trade in the universe. Like selling variance swaps. I think right now everyone and their mother is doing it. And one of the reasons you can see it is right here. You can see how it has been consistently. Some months it's kind of like a mean reverting kind of thing. But you have noticed that in the past it's coming down heavily, and the reason, for instance, that in 2017 the variance risk premium is so low right now is precisely because of that, because everyone and their mother are doing it this year. So it used to be the trade. I will say why I stopped the trade. I will say that this year in particular have seen the arrival of many participants that were not usually present in this market. Back in the day, in 2006, when I used to do this, we were only a few volatility funds, so not a lot of people will know about variance, and it was kind of heavily specialized, and we were only a few of us doing it. Now, because of nothing is happening with the market, now the market just drifts up, and finding edges are so hard. Most funds, even funds that are not related to volatility, are doing this. Even some mutual funds and even some banks are doing it. So they are crowding the market right now, and they are lowering the variance risk premium. It's incredibly low, but that's what it is. No, so I got a question that deserves to be answered. The question is why I stop. So I stop because of the next slide. So it's okay. So what is a variance swap? So a variance swap is an instrument. It's a financial instrument, but it is not like shares or bonds. It's a swap. And for those of you in the know, you know that swaps are OTC instruments. They are traded OTC, but this is not like the OTC where you trade penny stocks. No, this is OTC, the real OTC, like the interbank OTC, where like gigantic players trade them. So these instruments are mostly only accessible to institutions. I don't think I know an individual that can access a variance swap, because you need an ISDA to trade them, which is one of those contracts. It's a standardized contracts from the swap organization. So they will not give an ISDA to an individual. You have to be a very well-heeled, well-financed institution, and that's the reason I am not doing it, because I don't run a hedge fund anymore. No, so I am just a normal individual civilian again. So variance swaps are not at my reach anymore. So, but don't despair. I mean, even though the variance swaps themselves are outside retail traders, there are something called variance futures. So back in 2012, around 2012, CFE, which is the exchange that have VIX futures, in case you didn't know. So CFE is an exchange that is well known, and it has very successful products, including VIX. They decided to create something called a variance future. A variance future is basically a variance swap. It's exactly a variance swap. The only difference between a variance future and a variance swap is that the swap used to be like a contract between two parts. No, you will enter the contract, and that's it. There was not a secondary market for the swap. No, it's like it was really hard to get rid of it. You will have to sell it to the person where you contracted with. But even though the variance swap market is a very liquid market, and so it was easy to get in and out. So variance futures are variance swaps, and they changed the name to variance futures because they are a future exchange. So that I think that's the reason. And they didn't want to call it a swap, so they could be regulated by whoever is that regulates them. So I guess it's the CFTC that once regulates them. And the only difference is in pricing. A variance swap doesn't need to worry about intermediate pricing. You price a variance swap based on the term, like how long it is, what is the current level of implied volatility, and how many millions of notional vega you want to bet here. In a variance future, because it is meant to be traded, it is meant to be centrally clear. So it is meant to be traded daily, like a normal ES future or VIX futures. So pricing is slightly different. So there could be many buyers and sellers. So it doesn't have to have two sides. No, it can be something that can be traded by market makers too. So this particular instrument is actually available to retail traders. I mean, anyone can trade it. The only thing is that it has big margin requirements. I mean, when you trade VIX futures, for instance, one single VIX future is equivalent to 1,000. The size of the VIX future is 1,000 vegas, is 1,000 volts. Now every move, 1 point move in VIX will produce $1,000 of profit or loss. So that's that kind of multiplier is called the vega notional. So the vega notional of a VIX future is like 1,000 vega notional. And what is the margin for a VIX future? So usually the margin is very low. In times of low volatility, like right now, it could be like $6,000. I don't know. You can tell me. I haven't traded VIX futures in a while. I don't tend to trade them outright, so I don't remember the margin right now. It could go up to $9,000 if the market is misbehaving. But what I mean is a very low margin for the VIX futures. An equivalent variance future of the same notional Vega, 1000 notional Vega, 1K, could be around $40,000. So the margin is substantially higher. It can be, it can be 5 times higher, depending on the months. There are months that are really cheap. There are months where the requirement for 1000 Vega notional is only $20,000, or in fact I have seen some months where it's $10,000, but it still is a big margin requirement. So right there, it is kind of outside most normal traders. You still like, that's only for a single one contract, 1000 notional Vega contract, which is like a little contract. If you want to trade 100 contracts, we're talking about millions of dollars. But I mean, it is a product that can be used by retailers. The only problem the product has is that not many brokers offer it. Why? I don't know why. I don't know why they don't offer it. It's a great product. For instance, Thinkorswim, you can actually see the quotes in Thinkorswim, but you cannot trade it. That's the funniest thing. I mean, it is present. You can see the symbols. You can see the bid and ask, and it won't let you trade it. And the other thing is, because of that, it's not a very popular product, then it's not that liquid. But this strategy doesn't require liquidity. I mean, this strategy is I sell the variance future, forget about it, and do the thing the next month. So variance futures are very convenient to speculate on the variance risk premium. And one of the things that makes them really good is that variance swaps and variance futures are not connected to the price of the market. The market could go to the moon, the market could crash, and the variance futures doesn't care. It's a pure bet on variance. It's like the purest bet possible on variance, and that's what I love. Like, you don't have to worry about anything, and that's impossible to do with options, because even if you want to replicate this with an option trade, let's say with a very naive option trade. A very naive option trade is selling a put. Let's sell like a really out of the money put, and you are doing more or less the same. You're trying to capture the implied variance of that put, and you're betting that the market will never fall. I have a question for variance futures. Who is in the other side of the trade? It's like all the markets. I don't know if you folks have realized, but every single modern market is one-sided. There is no such thing as another side. Like the other side of the trades were like probably 100 years ago. You have other sides. Right now, there is no other side. Like the other side is a robot, it's a computer, which is a market maker, and it doesn't care. The market maker is just making markets for anyone. You want to buy here, you want to sell here. It really doesn't care. It's just buying or selling automatically. So modern markets only have one side. You are the only side. You have a view. You think something will go up, you buy. You think something will go down, you sell. But the other side doesn't have a view. The other side is just a market maker. So the same is with variance futures. The other side of variance futures are market makers, and they are the ones that will do the trade for you. So there are no participants. I can tell you that right now most of the open interest is zero, with a few exceptions. So, but it doesn't matter if it's zero. You enter and that's it. Yes, that's what it is. So when that's another question. Will they just hedge it away? That's correct. The market makers just hedge away all of the risk. So in a product like shares, for instance, market makers buy and sell, and they hedge by the balance on the book. If the buys and the sells are balanced, the total exposure is zero. So that's how the market maker works. They try to have the most balanced book possible. If the book becomes really imbalanced, let's say at the end of the day you have lots of buys or lots of sells, then you can you can find ways to hedge with something else. And the same with option dealers. Option dealers are hedging in a different thing. They are hedging, for instance, all of these option risks. They are hedging gamma, they are hedging vega, and it's the same thing. They try to have a very balanced book, and if there is any imbalance, then it will be hedged at the end of the day. So yes, market makers don't assume risk. It's not their business. They are making money just on the bid-ask spread. That's how they make money. So the thing with variance futures is, okay, variance futures is like a one interesting step, but are there other ways to strike VRP? And I mentioned, yes, there are other ways. I mentioned the naive way. I was interrupted when I was mentioning the naive way. One naive way is to sell out of the money puts. In fact, you could sell like 2,000 strike puts in the market, and you will get decent premium for them. Like, I mean, decent premium. If you go far enough, let's say December or January, you will get really good money. And that's a strategy I will guess now. And it's a variance risk premium strategy, because the implied volatility of those puts is gigantic and it will never happen. But it will, the fact is it might happen, and the market might crash, and those puts, the gamma exposure will be gigantic. And that's the only problem with those naive strategies, is that they have a tremendous gamma risk. A variance risk future or variance swap doesn't have gamma risk. There is no such thing as gamma risk, because they don't care about the direction of the underlying. So the only risk on these pure bets is the actual variance risk, is the risk of the realized variance versus implied variance. And as you can see, historically, even during the crash of 2008, the person lost probably like 50 balls on that trade. And that's nothing, because you could have made way more than 50 balls before the crash and after the crash. No, you are collecting 10 balls all the time. Is what I try to say is that the downside risk is limited. There is no such thing as infinite variance to a downside. It's different. Observe this. This is the realized variance. This is not VIX. In 2008, VIX went to like 80 or hundreds. I don't know. VIX could go to outrageous values. But this is not a bet on VIX. This is a bet on the actual realized variance of the market, and the market will not move in infinite ways. I mean, even if it crashes to zero, the total variance is not infinite. Is limited. That's my whole point. So the strategy does have limited downside, and it has consistent positive returns. So it's a good strategy. And in the gamma optimizer room, I'm going to start showing a few trades, how to profit from it, and using, first I'm going to explain the detailed methodology of how to use variance futures, even though they are kind of illiquid. I just want to go over them because I think variance futures are really peculiar, and they have a very cool mechanism for pricing. And then for those of you that don't want to do variance futures, but for instance, the margin maybe is too high, then other ways to strike VRP. So this is it for part 1. I appreciate that you are here. The whole goal of the discussion was to show that there are indeed some anomalies or inefficiencies in the market, the variance risk premium being one of them. There are many more, but this is one of them. And I just wanted to get the ball rolling in terms of how to play it. Now, I plan a second video over the weekend, but that one won't be public. That will be only for members of the Gamma Optimizer room. So, again, thank you for joining, and I will answer the question that I got originally here, that I was related to selling weekly options, no? And so I kind of spent several minutes talking about how terrible is that. And the question is, what about longer than weekly? It really doesn't matter. It doesn't matter the period that you are selling, and the problem is you are acquiring tremendous risk. Of course, the longer the expiration of the options you are selling, you get more premium, but you also have more opportunities to burn yourself. I mean, the market has more opportunities to reach the strike of the option that you are short. So the risks increase, and the strategies cannot overcome the fact that the edge is negative. However, the VRP trade, the variance risk premium trade, is connected to that in one way. I mean, it's connected to one aspect of time decay, but it's a different type of bet that has positive edge, as I have shown. Anyway, guys, have a great weekend, and hopefully I'll produce the next video soon. Take care, folks.